Various available sources. The main source of funds for a firm are uh, shareholders' funds and borrowed funds. The shareholder funds refer to the equity capital and the retained earnings. Borrowed funds refer to the finance raised through debentures or other forms of debt. A firm has to decide the proportion of funds to be raised from either sources based on their basis characteristics. Interest on borrowed funds have to be paid regardlessly of whether or not a firm has earned a profit. Likewise, the borrowed funds have to be repaid at a fixed time. The risk of default on payment is known as financial risk, which has to be considered by a firm likely to have influence in sufficient shareholders to make these fixed payments. Shareholders' funds, on the other hand, involve no commitment regarding the payment of returns of the repayment of capital. A firm therefore needs to have a judicious mix of both debt and equity in making financing decisions, which may be debt, equity preferences, share capital, and retained earnings. The cost of each type of finance has to be estimated. Some sources may be cheaper than others. For example, debt is considered to be the cheapest of all the sources. Tax deductibility of interest making it still cheaper. Associated risk is also different from each source. Example, it is necessary to pay interest on debt and redeem the principal amount on maturity. There is no such compulsion to pay any dividend on equity shares. Thus, there is some amount of financial risk in debt financing. The overall financial risk depends upon the proportion of debt in the total capital. The fundraising exercise also costs some. This cost is called floating cost. It also must be considered while evaluating different sources. Financing decision is thus considered with the decision about how much to be raised from which sources. This decision determines the overall cost of capital and the financial risk of enterprise. Factors affecting financing decisions. The financing decisions are affected by various factors. Important among them are as follows. Cost. The cost of raising funds through different sources are different. A prudent a prudent financial managers could normally opt for a source which is the cheapest risk. The risk associated with each of the sources is different. Flotation. Flotation costs. Higher the flotation cost, less attractive the source. Cash flow position of the company. A stronger cash flow position may make debt financing more visible than funding through equity. Fixed operating costs. If a business has high fixed operation cost, example, building rent, uh, insurance premiums, salaries, etc., it must reduce fixed financing cost. Hence, lower debt financing is better. Similarly, if fixed operating cost is less, more of debt financing may be deferred. Control consideration. Issue of issue of more equity may lead to dilution of management's control over the business. Debt financing has no such implications. Companies afraid of a takeover bid would prefer debt to equity. State of capital market. Health of the capital making market capital market may also affect the choice of source of fund. During the period when stock market is rising, more people invest in equity. However depressed capital market may make issue of equity share difficult to any company. Dividend decision. The third important decision that every financial manager has to take relates to distribution of dividend. Dividend is that proportion of profit which is distributed of shareholders. The decision involved here is how much of the profit earned by company after paying tax is to be distributed to the shareholders and how much of it should be retained in the business. While the dividend constitutes the current income reinvestment as retained earning. India Inc. issue bonus shares and dividends. Uh, Reinvest as retained earning increase the firm future earning capacity. The extent of retained earnings also influences the financing decision of the firm. Since the firm does not require funds to the extent of reinvested retained earnings, the decision regarding dividends should be taken keeping in view the overall objective of maximizing shareholders' wealth. Factors affecting dividend decision: how much how much of the profit earned by a company will be distributed as profit and how much will be retained in the business is affected by many factors. Some of the important factors are discussed as follows. Amount of earning. Dividends are paid of current and past earnings. Therefore, earnings is major de- determinant of the decision about dividend. Stability earnings. About other things remaining the same. A company having stable earning is in a better position of declare higher dividends. As against this, a company having unstable earnings is likely to pay smaller dividend. Stability of dividends. Companies generally follow a policy of establishing dividend per share. The increase in dividends is generally made when there is confidence that their earning potential has gone up and not just the earnings of the current year. In other years, dividend per share is not alternated if the change in earning is small or seen to be temporary in culture. In nature, growth opportunities. Companies having companies having good growth opportunities retain more money out of their earnings so as to finance the required investment. The dividend in growth companies is therefore smaller than that, the non-group company's cash flow position. The payment of also involves an outflow of cash. Company may earning a company may be earning profit but may be short on cash. Ability of enough cash in the company is necessary for declaration of dividends. Shareholders' preference. While declaring dividends, management must keep in mind the preferences of the shareholders in this regard if the shareholders in general desire that at least a certain amount is paid as dividend, the companies are likely to declare the same. There are always some shareholders who depend on a regular income from their investment. Taxation policy. Choice between the payment of dividend and retaining the earning is to some extent affected by the difference in the tax treatment of the dividend and capital gain. If the tax on dividend is higher, it is better to pay less by way of dividends as compared to this. Higher dividends may be declared if tax rates are relative are relatively lower, so the dividends are free of tax in the hands of shareholders. A dividend distribution tax is levied on companies, thus under the under the present tax policy, shareholders are likely to prefer higher dividends. Stock market reaction. Investors in general view an increase in dividend as a good news, and stock prices react positively to it. Similarly, a decrease in dividend may have a negative impact on the share prices in the stock market. Thus, the possible impact of dividend policy on the equity share price is one of the important factors considered by the management while taking a decision about it. Access to capital market. Large and reputed companies generally have easy access to the capital market and therefore may depend less on retained earnings to finance their growth. These companies tend to pay higher dividends than the smaller companies, which have relatively low access to the market. Legal constraints certain legal constraints. Certain provision of the Companies Act place a restriction on payouts as dividends. Such provision must be adhered to while declaring the dividend. Contractual constraints. While gaining loans to a company, sometimes the lender may impose certain restriction on the payment of dividends in future. The companies are required to ensure that the dividend does not violate the term of the loan agreement in this regard. Financial planning. Financial planning is essential. The preparation of a financial blueprint or an organization's future operation. The objective of financial planning is to ensure that enough funds are available at right time. If adequate funds are not available, the firm will not be able to honor its commitments and carry out its